Since Bank of Canada announced their monetary policy easing, we are seeing a significant downfall for Canadian dollar against USD. And if you've been watching my channel, you know that I've been talking about this for quite some time. And as I was explaining to you that as the interest rate differential between the Canadian dollar and the US dollar is going to be wider, this will have negative impacts on the Canadian dollar, and this is exactly what we are seeing right now. So Canadian dollar has dipped below 72 cents against USD, which is the lowest point since 2017. So this is a concerning point for Canadians because we import a lot of stuff in this country, especially the produce, the food that we eat, a lot of vegetables and fruits. They came from Mexico and California and other parts of the US. So a lot of those items like machinery, food items, and clothing as well, that is going to get expensive because now we have to pay more to buy the same stuff that we were importing previously. So that is going to be some inflationary pressures on Canadians because the stuff that is getting imported is going to get expensive. We also get some benefit with a weaker currency when it comes to exports. Okay, but oil is also struggling. We are seeing the oil has gone down below $70 a barrel. Okay, if the oil price is declining, that's really not helping Canadian exports, right? So that's also another pressure we're seeing from oil market slump as well. Definitely is going to be a challenge for Canada because when you go out, you're going to spend more Canadian dollars in order to buy same goods and services in the US. When the Americans, they come to Canada as a tourist, of course, it can drive some consumption because now they're going to get more stuff with the same US dollar that they used to buy. So it's basically both ways. But I think for majority of the Canadians, of course, when we are importing stuff and if we are going out as well, we are spending more Canadian dollar against the goods and services. So that's the state of the Canadian dollar. Now, why is it happening? Okay, let's understand why it's happening. The reason why it is happening is because bond market. That's the simplest answer. And if you're an investor, even if you're a retail investor, you should understand how the bond market works because that will give you a lot of intel with regards to what's going to happen in the future in the financial markets, because the market moves based upon the future probabilities. Okay, it's a forward-looking market. When we see that the Bank of Canada is signaling to the market that they're going to go aggressive in terms of rate cuts. Okay, they cut 325 basis point first, then they cut a jumbo rate cut, which is 50 basis point, and I think it's pretty much expected that they're going to go another jumbo rate cut in December. So that is signaling the market that this guy, Steve McLem, is going to get aggressive and is going to get a lot of rate cuts by the end of this year. Now, this is signaling the market that perhaps the economy is really struggling, which is why the central banks is being so aggressive in terms of cutting the rates. So the bond market consists of major money holders like pension funds, hedge fund owners, banks, foreign investors, foreign central banks as well, and they actually move huge capital across. Okay, so when they see that the real economy is struggling, okay, they're seeing the unemployment is rising, the earnings are missing, okay, the job numbers are shrinking, then they see that there is a lot of risk in the real economy and they don't want to lend that money into real economy or moving money into equity markets. Now, equity markets has been on bananas since 2020. Okay, when we saw a biggest bull run in the decade that the market went completely exuberant, there was an economy boom as well at the same time. But I think since last year, we're seeing a divergence between the financial economy, which is equity markets, and the real economy. Okay, the financial economy keeps still going up. Canadian stock market still all-time high, US stock market all-time high, but the Canadian economy is really struggling. Okay, if you look at GDP per capita for the last 6 quarters, it's negative. Okay, so if I'm the RBC Bank, if I'm the Scotia, or if I'm the pension fund owner, I'm seeing real challenges in the real economy, and I'm also seeing a lot of euphoria in the financial economy. So there's a lot of risk in the financial economy, and there's a lot of risk in the real economy as well. So in order to hedge against any downfall, I, as a big money holder, will move some of the capital from financial economy or real economy and park money into bond market. Why? Because bond market is the safest asset class, right? So why? Because it's issued by the government of Canada. Okay, so if the bond market is giving you 3% guaranteed return with no risk, and the equity markets are giving you, let's say, on average 5% return but a lot of risk, then majority of the money will go into bond market, which is why we're seeing the yields were collapsing. Okay, so bond price and the yield are inversely correlated. If there's a lot of bond buying happening, it will suppress the yields. So we're seeing for the past 6 months, the yields were crashing from all the way from 4.3% to 2.9%, right? For the past week or so, the yields climbed up again, but for the past 6 months, it has been crashing. Okay, that is a sign that the big money is moving into the safer assets, not in the real economy, not in the financial economy. Okay, the financial economy is still booming. There's still a lot of capital going into it, but it's a risk and reward. Okay, so the big money holders are kind of reducing their positions in the financial economy, like equity markets, and increasing their position in the bond market. Okay, and if I am the pension fund owner, I want to park my money into the safer asset, but when I see the US Treasury market is giving me 4.1% yield in USD, and Canadian bond market is giving me, let's say, 3% yield in Canadian dollar, where I'm going to move my money. Okay, so my capital will move into the US Treasury market, which is why we're seeing the pressure on Canadian dollar. So if I'm the RBC or pension fund owner, I'll have to sell my Canadian dollar, buy USD, and then move my capital into the US Treasury market. Okay, which is putting pressure on Canadian dollar, which is why Canadian dollar is getting weaker and weaker and weaker. Now, what is the projection? I don't know. Some are thinking it may go below 70 cents. Some are thinking it may go up to 60 cents. Who knows? But as of now, because of the huge differential in the interest rate, the Canadian bond market is not looking attractive. And who owns the Canadian bond market? It's actually, majority of them are Canadian institutions, Bank of Canada, banks, insurance companies, pension funds. They consist of 76% of the overall, and then let's say 23% is owned by the foreign entities. So yeah, that's the reason. I think that's the logical reason why the Canadian dollar is crashing hard against USD, and that's going to make things expensive for us, whatever we import. When this is going to change, I don't know. There's a lot of variable, there's a lot of cross currents in the economy, but I think the first thing we have to do is to make sure that the differential in the interest rate, it doesn't go further wider. We have to keep it close. So that's the concern that I have, because the Bank of Canada is signaling more aggressive rate cuts in the future, which is why the market is predicting and moving the capital into the US Treasury market. Anyway, you let me know what you think about that. Put your comments down below. If you like this video, give me a thumbs up and subscribe, and check out the links in the description below. And I also send a weekly newsletter on these topics. If you like these topics, consider subscribing to the newsletter, and I'll see you in my next video. Take care. If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later.